So next, Google just cratered nearly 10% in a week, a rare pullback for one of the tech's biggest players. Is this an overreaction or a golden setup for a rebound? With volatility heating up, we're looking at the best way to trade Google. So let's just take a quick look at. I went through a bunch of analysts' opinion about it, and I thought this one was particularly succinct, a good summary, and a good perspective on it. So let's just pull it up.
He's a portfolio manager at Gabelli Funds. Microsoft, Meta, Alphabet, Apple are all top 10 holdings in his growth fund. It's great to have you here. And when other people talk about whether we're going to rotate out of big tech, it's like existential for you because this is your whole portfolio. So just on Alphabet specifically, what do you make of the market's reaction?
Well, I actually think the market's reaction today is it's not that exciting. It comes down to margins, I think. Alphabet's a stock that tends to trade pretty sensitively to how they do on margins and profitability. It's a company that doesn't provide a lot of investor outreach, and I think changes in margins can really swing the stock, and they kind of missed on margins last night. They also provided an initial 2025 capex outlook, which was quite a bit ahead of where the street is. So I think this combination of softer margins and higher investment, the market's not liking that today.
It makes it clear that this is a company in transition, right? I mean, the reason why people loved the profit margins was because they just printed money from the internet business where you search for something, you get 10 links, tons of ads, and that was a high margin business. How high were margins at the peak?
Well, back to your comment on company in transition, I think that's the other key. Sorry to divert the conversation here, but I think this is AI is really driving a big transition for this company. And specifically at their core search business, I think there's been a question of how does search fare in a world of generative AI?
Absolutely.
What does search look like many years from now? Because for a long time, investors viewed search as sort of a utility on the internet, something that was always going to be around. A lot of people were always going to use it. AI comes along, people find themselves using chatbots more and more. Search becomes a little bit less important. So we're at this kind of inflection point for Google search. Now, what they're doing with AI in search is this thing called AI search overviews.
Right, which I love using, but I noticed there's no ads there.
Well, that's actually not totally true. They are starting to monetize that. And one of the key things they said last night on the earnings call was they're monetizing AI search overviews at parity with core search, which I think was really important data point. Like you, I like using AI search overviews as well. I mean, I noticed the other day, I Google searched how bad are the New York Giants, and Google search.
I don't know why you had to Google that. We all kind of know. But.
Well, actually, AI overviews gave a nice kind of context. It said, this year they were bad, but they might not be bad in the future. So I think it's actually.
So now it's predicting for you what it thinks might happen.
It's a helpful tool. It gives more context. And what Google's saying last night is AI overviews are driving more queries. So if it's driving more queries, more engagement, and monetization is at par with the core, I think that's a decent recipe going forward, particularly for a stock trading at a valuation that suggests that the market thinks this is a loser in AI.
All of which is to say, it sounds like you're unflummoxed by the dip and would even be a buyer here. But I would also wonder if the company, like you said, they haven't had to say a lot to investors in the past. It's a pretty straightforward business. It's a great one of the greatest that's ever existed. Do they need to talk more now about this transition and maybe talk about those margins, whatever might happen in the near term, talk about the investment, again, with an eye towards, okay, maybe 5 or 8 years from now, we can come out in as solid position as we were once in, because in our house, we're using a ton of other products. I still Google things, but I use a lot of other products as well. I do also use Gemini, and we do pay for that, but I don't know for how long that might be the case.
Yeah, so I think the key there is there's a new CFO. She joined this summer.
All right, that's not as interesting. Let's just stop right there. So there's two things I really like from this interview, and it sent me down the rabbit hole. One, I'm always looking for when is Google going to have its Yahoo moment, right? I don't know if you're like me or if you know anyone like me, but I like to be obsessed with how did Yahoo go from like a staple to just gone as a directory. So I'm always wondering, is Google going to be jumping the shark? I did not realize that their search volume is up. Right, he even says here their queries are up.
It's creating additional queries. Once you've gotten past the overview, you end up adding to your queries. That totally makes sense. Yeah,
and that they're ad placing within the AI queries within the overview, which I find to be fascinating. And so, just like we were talking about on the heels of the Palantir story, if there's one thing Google has, is 2 decades worth of data.
Sure.
and we know that
and a distribution network.
Correct.
Right.
And we don't know. We have no real ability to put a number of what that data is worth, because as they come up with new combinations of ways, and as even other people find use cases for it, right? OpenAI opened up a new avenue for business for Google by proving that this avenue was worthwhile, but then Google could jump in the game and participate. And so, one, we don't know what the value is there. And two, they're not fading away. They are innovating on these different things. They do want to change. So she mentions here this idea. Hey, what if they're evolving now, but it'll take 5-10 years before we actually see the returns on that, and now it's not worth investing in there. And I'm not really seeing where it'll take 10 years for any of this stuff to happen. These things are happening pretty quickly.
Way faster. Yeah.
Way faster.
Right.
And so when I see a dip like this for Google, I go, okay, this is something that you actually, I just want to pull it up over here real quick. I'm going to show you the chart of Meta. Do you remember when Meta dropped? What was this? Like 76%? This is not the COVID drop, folks. This drop in Meta is not the COVID drop. This is the COVID drop.
Right.
All right. And it V'd up, and then it dropped. What is it? Yeah, I think it was 76% in value. And I was like, oh my God. Is that the end for Facebook? Well, we're in a different world. This is not the world of Yahoo anymore. Now we have software, and the pivots that can be made can be so dramatic that you can have Facebook going from the lows up to here of 700%. Right? And so the switch that can happen with Google, to me, is the turn that they can make in their innovation. To me, you should bet on that happening. And if that's the case, well, the trade for old Tommy Boy is calls on Google options.
Sure.
We saw this from Kem talking about it last week, that if you express your bet in call options, you get asymmetry to the upside. You get it. You get to participate in the up move without being as exposed to the downside, and you only have to risk a certain amount of capital. This
Sure.
is the thing I find so fascinating about this Google trade. One thing I do want to add to that. So I actually want to play. I want to play just a little short clip from Carson on an interview with Adam Taggart, Thoughtful Money. And he says in a very articulate way something that I've been waiting for someone like him to say, which is the pitch for that options are the best way to trade the market, not the underlying. If you have, anyways, let's see what he has to say here.
No investor at this point should be betting on up or down. If you're betting on up or down, you're living in a cave somewhere in the dark ages. The reality is, when you make a decision about anything, you have some information that is nuanced. It is very specific to a bet that is not just up or down. Do you want to be long a stock? Well, maybe you like parts of a stock, or you think that it has a high probability of really a big potential payout if they get some drug approved, or come up with some innovation. But that doesn't mean you like everything about that stock. There's probably risks to that stock that you don't like, or outcomes that over time and distance that are not good bets. Every asset is a complex three-dimensional thing, and whether it's a stock or a bond or commodity, and every piece of information is nuanced. So we should be betting on the information we have, the edge we believe we have. And if you want to get the best risk-adjusted reward in any scenario, you should be trying to align the bet that you have based on the view that you have in the most specific possible way. And you can do that. Like, it's easy to do that now. Why would you just be long or short of the asset in response to the information that you have? So I think that's the way people need to reframe and think about bets. Probabilistic outcomes. You and I, when I make a decision, we don't just say yes or no. We think about there's this piece and there's this piece, and we're probabilistically trying to come up to the best. I think not everybody may do the math in their head, right? But they're thinking about the nuances. So there needs to be a more that kind of thought process. So when I'm saying be long, volatility, you need to go look at the distribution of outcomes and see what part of that distribution is way too cheap, and owe those parts. And maybe that might be long, one part betting on an up move, and maybe one part betting on a down move. And they're both very specific bets at the same time, but you may not be long or short. You may be betting on certain paths of outcomes which are way more likely, right, relative to their pricing, while ruling out all the other parts that you think are relatively fairly valued, or maybe selling one that's expensive that's on the downside and buying one that's cheap on the downside. So
Got it.
I think we need to be much more nuanced in how we bet. And by the way, people are like, why in 2021, people are like, this options boom is, it's a short-term, people are betting money and they're betting like crazy and this will fade. And I was there in 21 telling people, no, this is much like work from home. This is not going away. This is the acceleration of a trend that's been there since the beginning of options that will continue to take hold. They're a superior technology, a superior way to bet on outcomes. They're more specific. And at the end of the day, guess what? There's a reason the options market is eating underlying markets, because underlying markets are just an expected value of a much richer distribution of outcomes. They are simply, when we talk about the tail wagging the dog, they are the tail. They move based on how the different parts of the distribution and the market move. There's simply an average of every single infinite outcomes that can happen in the market. And if you peel away the options train, you'll see what those past and outcomes actually are. And so that's what we should be. That's how we should be positioning.
So I agree. I think in general, options always represent a different way to express your view on a company. And maybe one interesting takeaway from what he's challenging us to think about is an often overlooked and not really well talked about or appreciated aspect of what Google's working on, which is their Vertex AI offering, which is their enterprise AI solution. I got a chance to actually demo this as part of Google's onboarding for another system I'm working on, and the Vertex tool is more of an AI pipeline that's directed at larger enterprise customers that can pull in their own internal data, ensure that it's secure, and actually produce much more interesting model results from that. Sort of pointing back to what we were saying about Palantir and how they have access to all this interesting information that gives them a competitive edge. Companies that are leveraging their own data using tools like Vertex can leverage AI in a way to their advantage, which gives them much more efficiency, right? And as far as I can tell, I don't know that OpenAI has a similar enterprise level offering. And there's obviously far more retail involvement or regular, general consumer involvement or use of OpenAI than compared to something like Vertex. So an interesting way to express this trade is to say, well, there's kind of an enterprise competition model here, right? More of a B2B model that needs to be considered. And I think Google might have an opportunity to gain stakehold there that other companies aren't necessarily paying attention to, or at least we're not hearing much about it. What are your thoughts on that?
Well, that's one of those other avenues that, like the innovation that Google's making into AI. People are acting like the $75 billion that they earmarked for it in their last earnings call. Oh, it'll take 5-10 years for that to pay off. They've already been doing this, right? I don't know if you saw this interview with I think the guy who's the head of AI at Google at a TED conference. They asked him, so why did OpenAI beat you guys to AI to market?
Sure.
And he says, we've had this for years,
Mm-hmm.
but we thought that the hallucinations were a deal breaker for people. We had no idea. The people were like, no, that's fine. Let it hallucinate. I'll still give it all my information, do whatever I need to. But they've been developing these things and these tools, and they've been thinking about how these things can merge together. Alex Karp in another interview states that the reason why he wasn't worried about DeepSeek is because it's not just the base LM models or any of these AI models that they're using. It's the infrastructure necessary in order to support this and turn it into something that's actually useful.
That's
That
right.
whole culture, the whole pipeline, and Google has that in spades.
Right.
And so to see their recent earnings as like, oh well, now they're just dipping their toe into AI to begin with. No, that's
They've been
ridiculous.
at it for a long time. I think they're also getting pretty aggressive lately with trying to incorporate Gemini across all of their products. Which, back to my earlier point, they have a large distribution network here, right? Their ability to put their product in front of as many eyeballs as possible gives them this advantage that they're now starting to take advantage of. So you're finding Gemini is showing up in your email, it's showing up in your Google Drive, it's showing up in your conversations. You can do AI summaries of emails now. Like they're slowly trying to introduce the product to you so that it feels more natural for you to want to use it. And it's a timing factor there. More and more people have to adopt it before they feel much more comfortable with it. But I just want to point back to the enterprise offering, the Vertex AI offering. I think it's pretty interesting because it starts to move more and more companies towards using models at scale in ways that they've never really thought about before. And I think that's a huge opportunity.
So, like in the same vein as like Palantir's ontology, their sort of thing, like they're packaging AI in such a
More
way.
like a self-serve model though, right? Like they'll give you the ability to onboard and sort of establish the connections to all of your resources necessary. They get you set up with BigQuery, you start importing data, and now you can build models on top of that. I think we're almost at a point now where companies can start leveraging the power of machine learning and AI without needing a huge data science team or a third-party consultant in order to do these integrations for them. And that sort of democratizes the power that AI can really present companies in terms of efficiency and predicting outcomes. We saw this earlier about what Palantir is trying to provide just a hospital alone. There's enormous opportunity for efficiencies across every industry and every business sector in the world. So this could be a huge play for Google in my mind.
That's right. All right, so I just want to end on this one last thing as a pitch for if someone wants to dip their toe into options. If we take a look at the Google chart right now, and we just measure the types of dips that they have, I'm expecting Google to get down potentially down to the 175 area over here in order to get its bounce. And if it does bounce from around here back up to its highs over the next 2 weeks, months, or whatever, there's a possibility of placing just a single, just regular call options. You don't have to have anything too crazy for your for the options, and it would return anywhere between like 200% to 500% if we move back up to all-time highs, which is just 20% away from the bounce within about a month's time.
I
That's
love it.
a bet that I like.
Yeah, and not only do I like the bet, but I also like Google's positioning better than Palantir's. They're not significantly overvalued. In fact, I'd place them at a price target of roughly $280 a share, even from current prices, just based on discounted cash flows in the future. So intrinsic value looks good, growth looks good. They're sitting on plenty of cash. There's plenty of opportunity for them to grow, especially and compete in the AI space. Analysts are projecting them growing well into the future and at a pretty healthy clip. So yeah, the options play makes a ton of sense. Were you going to demonstrate how to price this one out if we wanted to buy roughly at the, what are we thinking here? The
Well, I was thinking right now
170 mark, 175 mark?
I don't have any tools that allow me to determine what the price of the option will be at that location.
Correct. Yeah.
So just assuming it right now, if you were to buy it today, yeah, I could just show that again. Um,
Yeah. Let's
basically,
assume we get somewhere to around a 250 to 280 price target.
oh, well, I was thinking within, let's say, a month time. So just the bounce off the level.
Okay.
So if that were to happen, then you can get something like what is it, a $32 investment for or $31 investment for one of these options contracts
Mhm.
versus the 185 you'd be paying for the actual share.
Sure.
If you just bought the share 195 or let's say 175 and it went up 20%, fine, you made it 20%. But that same value instead of options contract, if it bounced within a month, would bring something around 542% return at the
Yep.
price of the option right now. And this option, when the price gets to 175, will be even cheaper. It might even be half this price,
Right.
right? Because this is a call option.
Allowing
So
you to
you
load up a bit more.
load up even more. So you could start buying now or wait till it gets down there, and all of a sudden you're buying it at $16 to $20 per option, and you're making 700%, 800% on the move up. Not to mention a blast past there.
Not to mention the asymmetry of the trade relative to holding the underlying stock. So, the tough part about buying these shares directly is the drawdown you experience if prices continue to go down. With an options contract, you have that fixed premium cost, and if you let it just expire worthless, that's the only risk you're really putting on the table.
That's right. Which is, what is it? It's just so much less. And anyways, so that's what Cameron's saying. The risk adjusted return.
Mm-hmm.
Fine, you had the theta decay, but you're putting, and it might expire worthless, but you're putting so much less down on the table. You could take that bet multiple times, and it might equal to what your stop loss would have been if you had put a much larger position on. So because people are not putting the long position on for the underlying asset and then writing that to like with the idea that it would go to they would drop 50% of this. They would just take that, unless that's what you're doing. If you're just buying the asset, you're like, I'm going to hold it for the next 10 years, and I don't care if it goes up and down. Then we're not talking about that. We're talking about that you have a view that you want to express. That you're like, I think that the sell-off was overreaction. Fine, then take advantage of that overreaction and place your call option and reap the benefit on the backside. And if you're wrong, well, you're out a few bucks.
All agreed there.